Hello and welcome to the State of the Fleet Industry, a weekly video series produced by Automotive Fleet magazine. I'm Mike Antich, editor of Automotive Fleet, and today I'd like to examine what's occurring in the fleet industry for the week of September 5th, 2022. And for this week's episode, I'd like to examine the growing concern by fleet managers about future depreciation risk for vehicles that they'll be remarketing in the wholesale market in the next several years. Specifically, they're concerned as to whether vehicle resale values 3 years from now will be sufficient to offset today's higher acquisition costs. And the fear is that the resale values in this time frame will soften. They'll soften in the coming years, and that won't be sufficient to offset the higher depreciation risk that they've incurred now, thereby increasing their overall depreciation expenses. In today's market, not tomorrow's market, but in today's market, higher residual values are more than sufficient to offset these increased acquisition costs. And the question is whether this will hold true in the future. The used vehicle market is a cyclical market, and used vehicle prices closely correlate to new vehicle prices. So historically, there's always been a percentage gap between the price of new and used vehicles. But this gap blurred in calendar year 2021 as new vehicles suddenly became appreciating assets, which previously was an unheard of phenomena. In fact, used vehicle prices are appreciating faster than new vehicle prices. So for instance, used vehicle prices are up 42% over January 2020 levels, while new vehicle prices are up only 12%. So the gap between the two has decreased. And during the past 2 years, we've all been experiencing end user demand coupled with this ever increasing pent up demand continuing to exceed vehicle supply. And as a result, the OEMs have decreased their fleet incentives because, frankly, there's no need to stimulate buyer demand. The OEMs are selling everything that they can make. In fact, demand is so strong for some popular truck models that their entire fleet allocation sells out within days after opening their order banks. And likewise, when out-of-stock purchases are required to replace an accident-damaged vehicle or obtain a vehicle due to some other unexpected contingency, fleets are buying units from dealers at MSRP, and they're paying a supplemental market adjustment fee, which is often a substantial amount of money. So with these supply constraints limiting total vehicle production, it's also prompting automakers to focus on building model configurations to maximize their profit per unit sold. And if you don't believe me, try buying a fleet-equipped pickup truck. Nowadays, it seems that the only pickups you can find are those decked out with content-rich option packages, all geared towards retail customers. And this is another factor exerting upward pressure on fleet acquisition costs. There's multi-pronged pressures on higher acquisition costs. Despite all these pricing pressures, fleet managers to date have been grudgingly accepting these increased acquisition costs because they believe these higher upfront costs will be offset on the back end with higher resale values. And up to now, it's been true. And the data seems to support this contention. But today, there's a growing fear among fleet managers that future resale values will decline as new vehicle production increases due to receding supply chain constraints. Eventually, we're going to get out of this supply chain disruption, and new vehicle production is ultimately going to return to higher levels. This is going to have a direct bearing on used vehicle prices, and it's going to have a direct bearing on new vehicle prices. And here's what one fleet manager told me. Quote, "For the past 2 years, I've been buying new vehicles at elevated prices. I worry when these vehicles are remarketed 3 years from now in a more normalized used vehicle market, whether I'm going to be upside down on all of these units." And this isn't a new concern. This concern's been percolating since December of 2021 when KPMG, one of the global Big Four accounting and audit firms, published a white paper saying it expected a dramatic decline in used vehicle prices in the fourth quarter of 2022 or early 2023. And they predicted that used vehicle prices would drop 20 to 30%. So here's the quote from KMPG's white paper. Quote, "Whatever path the new vehicle market takes to the new normal, used vehicle prices will eventually return to the traditional relationship between new vehicle prices. In other words, a 20 to 30% plunge in used vehicle prices is in the cards. Well, I do have my doubts about the KMPG forecast that there will be an equilibrium between new and used vehicle sales in 2023. And personally, I think this is premature, but I'm 100% in agreement with KMPG's premise of that an equilibrium will invariably occur sometime in the future and will exert downward pricing pressure in the used vehicle market. I think a safer forecast is for this equilibrium to occur in calendar year 2024. But regardless of which calendar year it occurs, there most likely will be a lot of vehicles that are going to be underwater in both the retail and fleet markets as a result of that readjustment. So you ask yourself, who buys used vehicles and what are the dynamics that are impacting their purchase decisions? When looking at the fleet market in total, there are three main categories of buyers for used fleet vehicles. One, employees buying company vehicles, grounding dealers who deliver the replacement vehicles and buy the out-of-service fleet vehicle, or independent dealers who buy fleet vehicles at auction. And the overwhelming majority of commercial fleet vehicles are sold to these independent dealers who primarily sell these vehicles to customers who typically have subprime credit. And auctions are typically the primary source of fleet vehicles that are sold to these subprime buyers. So as background, if you're not familiar with a subprime auto loan, this is a type of loan that lenders offer to buyers with low credit scores and poor credit histories. And these loans are for people with credit scores below 600. So what has negatively impacted subprime buyers have been the recent increases in interest rates. And these interest rate increases have been substantial. If you're a subprime buyer, you're now looking at an interest rate between 17 and 21%. So with today's used vehicles selling at historically high used vehicle prices and an average 20% interest rate, it creates an affordability issue for many buyers of used fleet vehicles. In the used vehicle market, what determines whether a used vehicle will sell is the monthly payment. As today's used vehicle prices and double-digit interest rates become more commonplace, it's becoming harder and harder to arrive at a monthly payment that works for this buying segment. And this creates a cascading effect throughout the remarketing chain for used fleet vehicles. Higher end user costs exert downward pressure on prices that dealers bid at auction so they can keep these vehicles affordable to their subprime customers. But there's one thing that I've learned, and that is that the used vehicle market is highly susceptible to outside market forces. And based on this understanding, there are three potential scenarios as to what might occur in the used vehicle market in the next 12 months. So the first scenario is that vehicle prices will decline at a more manageable rate instead of that abrupt drop that KMPG was saying, but they decline at a more manageable rate, pushing prices down ultimately to pre-pandemic levels. And that would be the best scenario. A second potential scenario is that the Federal Reserve may not be successful in controlling inflation, and inflationary pressures will continue for longer than expected, which will help keep used vehicle prices elevated. And the third potential scenario is also dealing with the Federal Reserve, but that its response to inflation hits too hard and creates a more dramatic slowdown in the economy than desired and ultimately stifles used vehicle demand. Ultimately, there will be a normalization to the used vehicle market that will eventually take us out of this pandemic-induced abnormal market, and it is an abnormal market that we're currently in. But ultimately, there will be a normalization. So let's hope that this normalization will occur at a manageable rate and it does not create a depreciation bubble that creates a lot of negative equity for a large number of fleets. So with this as my final observation, I'd like to conclude my State of the Fleet Industry presentation for the week of September 5th, 2022, and I'd like to thank you for watching.